Welcome to the Business Scholarship Podcast, interdisciplinary conversations about new works in the broad world of business research. I'm your host, Andrew Jennings. If you like what you hear today, please consider subscribing to the podcast or sharing with others who might like it too. And if you have ideas for future episodes, let me know. My email address is andrew@andrewkjennings.com, and I look forward to hearing from you. Our guest today is Aneesh Raghunandan, Assistant Professor of Accounting at the London School of Economics. We'll be discussing his new article, How Are Non-Financial and Financial Misconduct Related? You can find a link to the article in the liner notes of this episode. Aneesh, welcome to the Business Scholarship Podcast.
Thanks for having me.
Our topic today is your new paper, How Are Non-Financial and Financial Misconduct Related? Just to start us off, could you give us an overview of this piece and what prompted you to write it?
Sure. So part of what got me to write it was almost opportunism. A lot of cool new data became available on non-financial misconduct that we just never really had before. And I'd kind of been wondering for a couple of years, just throughout my PhD, why sort of nobody had tried to get at this question. So we know a lot about, for example, the determinants of financial misconduct. We know a lot about, for example, how firms trade off certain very specific non-financial decisions, for example, maybe accelerating sales to hit a target. And so we know a lot about how firms will trade off very specific non-financial decisions with financial decisions. So for example, for the accountants out there, this is just kind of the trade-off between real and accrual earnings management, right? Which is to say, do I cook the books or do I just kind of take decisions that are long-term foolish but short-term beneficial? But nobody had really been able to apply that to a kind of longer term setting. And the reason for that is accruals reverse. Basically, if you cook the books now to make it look better, it's going to come back to bite you in the future. And so prior work on this kind of stuff had to focus on the short term almost by default. But a lot of financial misconduct tends to be motivated by longer term things. So saying not just how do we make earnings this quarter, but how do we sort of convince investors that we're sort of long-term sustainable. And so to me, it was a question where even though it's like kind of an extension from, it's in one way, it's an extension of a question, but in another way, it's a totally different question because the incentives at hand are quite different. And so nobody had sort of tried to bring this link to the case of outright misconduct. And then sort of more generally, I think it's always tricky to try to generalize something that's shady but legal into the, something that's actually illegal. I mean, you can think of it basically like lawyers would tell you to do one thing and tell you not to do the other, right? And in some sense, so the decision-making process that leads to misconduct is probably going to be quite different from the decision-making process that leads to sort of stuff that's within the boundaries of the law. And so I really just wanted to see if something that we sort of take as common knowledge, if it's actually common knowledge, if we try to extend the definition of what is non-financial misconduct and what is financial misconduct. So when I sort of came into this data, I realized, look, I can answer a question that nobody's really, I'm sure a lot of people have thought about it. It's just something that we haven't been able to answer for data reasons before. And so let me try to see if I can be a first mover on this. Yeah, so that's kind of, the sort of what got me into it. It's a question that I think I and many others had. It's not a particularly novel question, but I think it's a question we haven't really been able to answer in the past.
So your research is really focused on the question of when are financial misconduct, for example, accounting violations, when are they concurrent with non-financial misconduct, which a good example from your paper is a wage hour violation where somebody is probably not exempt from overtime, but I decide to improperly classify that person or a lot of people as exempt from overtime so that I can reduce my overtime expense. Could you describe kind of how you set that question up and maybe empirically how you went to test that question?
Sure. So actually, to answer to that very specific example, what got me interested was so I just kind of looked through this data and I was trying to figure out, okay, what's in here? What are the big cases? What are companies actually doing? Right? Because it's easy to sort of read the news and read about, a company did this or a company didn't pay overtime. But I wanted to see sort of what are companies actually sort of systematically getting penalized for to get a better sense. And so in a sense, it's data driven. In a sense, I saw, hey, look, there's a lot of these big these big issues pertaining to underpayment of wages, and one example that sort of really got me was IBM in 2004, because I got my PhD at Stanford and I was in Silicon Valley. And so IBM in, I think it was '04, it might have been '05, they started to have a pretty bad quarter. And so they basically said, okay, we need to cut employee related expenses immediately. And they said, okay, well, so we can't really just do this in one way. So let's do multiple things. Let's misclassify our technicians, and that'll take care of some of the margin that we need to make up. And then let's also sort of misrepresent the impact of expensing options. So it's basically, here's a tool we have. We can cut employee-related expenses. And if we do too much of one thing, we might get caught. So let's do a little bit of one. Let's do a little bit of outright just kind of not paying our technicians, and a little bit of the other, which is kind of funny accounting over the treatment of their options. And so to me, that was kind of a really salient example of this is something where historically we would only have focused on the sort of option side of this. We wouldn't have really thought about the fact that they were concurrently doing something related, but that would just kind of manifest in a different type of violation. And so I got into wondering, is this kind of more of a systematic thing? Are there more companies that are kind of starting with saying something like, oh, we need to do X in order to make up, for example, earnings? And then saying, okay, we can do it. We can get a little bit here by cooking the books over here, and we can sort of tighten things over here in an operational sense. So basically trying to get a sense of, okay, so we have one main motivation. Do we tinker with both the financial and the operational side, or are they really truly separate? And so I was kind of interested in how separate or similar they are.
And how were you able to test that from just you mentioned a new data set became available that allowed you to look into this question?
Yeah, so that's a new database called Violation Tracker. It's put out by a nonprofit organization called Good Jobs First. And what that basically does is it just kind of, all the information in there is publicly available if you know where to look. It just so happens that no one had really bothered to collect it all in one place before. And so what they do is they basically say, let's take every major US federal agency, and let's take basically all the penalties they assessed to individual firms, whatever the reason, from 2000 onward. And so they just sort of kind of put that all into one place. And there's some information about sort of what the penalty was, who the company, who the company that received the penalty was, the issuing agency, what it was for, the amount of the penalty, when it was assessed. And so you can kind of use that to match it up with existing data on financial misconduct. And once you have that in place, once it's the real issue with this was getting the non-financial misconduct data, getting it cleaned up. Good Jobs First, their main audience tends not to be academics, and so they tend to format the data in a way that's beneficial to their main users, which tend to be policymakers, which tend to be think tanks. And so it took a lot of work to sort of get it into a format where I could merge it with the common academic data sets. But once that was in place, it's a relatively straightforward thing to do. And I think, to me at least, one reason this hadn't been done is just a lot of the penalties are actually quite small. One kind of really interesting institutional feature to me is that the penalties for financial misconduct tend to be, there tends to be a lot of discretion. So, for example, the SEC has a lot of say in each individual case setting what the penalty is. And, just because we assessed a fine of $50 million to one firm doesn't mean we have to come after you for the exact same amount. But that's not really true for most other agencies. And so a lot of the penalties in here are actually pretty small. And so even if the underlying sort of misconduct that generated the penalty was pretty substantial, the actual financial impact on the firm as far as what they would have to pay would be quite small. And so it's something that investors just might not have really been interested in, because for the companies that are in here, we're talking companies with billions in market value and market cap. It's just not something that would materially affect their books. And so that might be why it's a question that no one's really bothered to ask for so long, I think.
Did you find that there were certain types of penalties or violations that were more common than others? And maybe in terms of scale, how does that compare to the number of accounting enforcement actions or investigations that the SEC or the criminal elements of the DOJ are able to do?
Sure. So one other major institutional difference is that SEC and DOJ and a couple other agencies, they assess penalties on what I call an intent basis, which is to say, it's not enough to say, oh, look, the stock price dropped by a lot, you did something wrong. The SEC has to actually go and prove that somebody inside the firm intended to deceive investors. And that can take a lot of time. It can take a lot of resources. And so the SEC conducts, for example, less than 1,000 investigations a year, and they might file a couple hundred enforcement actions a year. But a lot of other federal agencies, actually most federal agencies, it's pretty cut and dry. Instead of being based on intent, they assess what I call outcome-based penalties, which is to say, if you're the EPA, for example, we just need to show that your carbon emissions are too high. It doesn't really matter if you meant for them to be too high or not. So because we only have to prove what you did, not why you did it, we can conduct many more investigations. So by way of example, so OSHA works like this too. The department, most of the Department of Labor kind of sub-agencies, OSHA, the Wage and Hour Division, the NLRB, they all kind of work like this. And so, for example, like I said, there's about 1,000 SEC investigations a year that might result in a couple hundred enforcement outcomes. Conversely, the Wage and Hour Division, for example, the OSHA, for example, they have about 40,000 investigations a year, and that might result in about 5 to 10,000 enforcement actions in a year. Now, obviously, the enforcement actions in here are a lot smaller. The SEC, we tend to think in terms of millions. The OSHA violations, we tend to think in terms of thousands. But in the case of the SEC, in the case of financial misconduct, one thing you'll see in the FT, the Wall Street Journal, the financial press, is that it's just impossible for us to know everyone who's cooking the books. It's just there's no way we can track everyone down. That's not necessarily the case with these agencies like OSHA or the EPA, because they're able to conduct so many more investigations.
So it sounds like the detection of non-financial misconduct may be the probability of detection might be higher than for financial misconduct. You found that firms concurrently engage in financial misconduct and wage and hour violations and environmental violations. Why might that be, and why might that result not have followed with other types of violations, for example, workplace safety or other forms of non-financial misconduct?
Sure. So actually, just to clarify, I actually found that firms concurrently engage in financial misconduct and wage and hour violations. But the relation between financial misconduct and EPA violations is actually not concurrent. What it actually is firms start cooking the books essentially, and then kind of next year or later on, they start also engaging in sort of bad environmental conduct. But one reason that it might be, for example, true of the Wage and Hour Division, whereas it, for example, I don't find such a strong relation with OSHA. One reason might be, for example, the time it takes to realize the savings. So if I cut your wages now, I get that money right away. In the case of OSHA, it may not always be the case. And so I actually do have some weak results on OSHA kind of later in the paper. What I do find is that sort of consistent with prior work, OSHA and wage violations are sort of positively associated with companies under pressure to sort of meet or beat earnings expectations. So basically, if a company is sort of at risk of missing an earnings target, I do find that sort of OSHA and wage violations go up. But yeah, for like you say, for the paper's main result is sort of more limited to wage violations. And that could be for a couple of reasons. It could be one, like I said, wage violations they realized right away. The other thing, and this is kind of more recent, is that executives can actually now be held personally responsible for wage misconduct. So in some sense, the cost structure is more similar for financial misconduct and wage misconduct than kind of any other type of misconduct. The other thing that you can think about is wage violations often come from kind of cost-cutting directives. And sort of one salient example is healthcare. So in the U.S., I believe it's if you are an employee who works more than 30 hours a week, you're classified as full-time, and that means the company has to give you health insurance. And so, if you don't want to pay for health insurance for thousands of employees, one thing you can do is to say, make sure that these employees only report 29 hours a week, right? And that's something, that kind of cost-cutting directive would come directly from the CFO. Whereas, for example, deferring maintenance, right? That's more likely to come from the operations guys. And so it may be the fact that my sample is limited to big companies, and so I acknowledge that as kind of a limitation. But you get a lot of decentralization in these big companies. You get, for example, the CFO might not know everything that the COO is overseeing, and vice versa. And so wage violations are likely to come from basically no matter who directly violates the law, those directives are likely to come from the CEO and CFO, whereas that might not be the case for other types of violations. And sort of, I guess, on the other one, on EPA violations, I think that's kind of just generally indicative of the fact that when you sort of commit environmental misconduct, you don't always realize the gains right away. What you're really doing is kind of underinvesting in, for example, maybe proper waste disposal or proper you might be sort of violating the Clean Air Act. These aren't things that necessarily give you benefits right away. They're things that reduce your kind of longer term costs. And so it kind of makes sense to me that financial misconduct would precede this, because you say, okay, we have to sort of hit a certain target. Let's cook the books a little bit. And then you realize that you're still not kind of long-term sustainable. So you start taking actions that actually sort of reduce your costs long-term. And sort of one kind of good example of long-term environmental misconduct would be the Volkswagen diesel emission scandal that we kind of heard about in the last few years. So Volkswagen, it's in basically skimping on their. I hope I don't mangle too many of the details, but basically, they skimped on their diesel emission systems, right? So the cars were polluting more than the owners thought they were, and basically, in doing so, that meant that they didn't have to make quite as much of an investment into new technology that would legitimately reduce diesel emissions. And so that allowed them to produce the car cheaper. And that's not a decision you take if you need to hit a target this year. That's a decision you take if, for example, you say, okay, this is a product line that's going to last for several years. We're at risk of underperforming on this entire product line. So let's drive up the margin on not just a few cars this year. Let's drive up the margin on every car sold for the next, 5 years. And so and not to say, obviously not every incidence of environmental misconduct is that severe. That's probably one of the most severe cases in the entire data set. But it's kind of indicative of the sort of thinking that goes into a lot of these environmental violations, that they tend to be longer term. And that might be why sort of I see that financial misconduct precedes it. So basically you say, okay, let me just cook the books for now, see how it goes. And then you realize you've got structural problems. So you take a sort of more structural solution, if you will.
So there's some temporal effect where perhaps in this quarter, I need to make my earnings this quarter, and I do the direct and easy thing, which might be, for example, misclassifying employees. But that's kind of low-hanging fruit. And once I've done that, it doesn't really help me in the next quarter per se. And I might look at more long-term misconduct opportunities to make that more sustainable adjustment.
Exactly.
Some of the non-financial misconduct that you found or that you've looked at is really kind of based on the data set that you have. Based on kind of this temporal horizon point, are there other types of non-financial misconduct that might be out there that aren't necessarily captured by the data set that might be concurrent or that might precede financial misconduct?
So this is something I've thought about because I worry that I'm not, so obviously when I'm limited to this data, I can't really think of, I guess maybe the better way to think of that would be, I don't know that there's necessarily types of misconduct that are not captured. The one thing that kind of I'm more worried about is that I may be missing instances of, the types of misconduct that are already in here, but for which there's kind of a different resolution. So for example, let's say you get penalized by the state of California instead of, the U.S. government, right? So let's say a lot of states have their own kind of environmental regulations, workplace safety regulators. And so let's say you get penalized by one of those guys instead of the federal agency. I wouldn't be able to pick that up. And the other thing that kind of worries me, or that I sort of would like to have more of than I do is data on lawsuits. And the reason for that is for financial misconduct, I actually measure it using a combination of SEC enforcement actions and significant shareholder lawsuits that result in significant settlements. And these are both proxies that have been extensively used in prior literature, and it's generally accepted that these both serve as two of several proxies for financial misconduct. And so I have the analog of SEC investigations because I have the federal agency penalties. I don't have data on lawsuits. I don't think it's as big of a deal as in the case of financial misconduct, and the reason for that is, I'm sure you've heard of mandatory arbitration clauses, and so a lot of things just, obviously I can't. If I had data from arbitrators, it'd be even better, but I don't think that's coming. So a lot of I'm not sure how much value lawsuit data would give me, because a lot of things sort of almost by virtue of the employee's contract with the employer would never make it to a lawsuit. But I would like to, for example, test, just to see which penalties actually wind up in a lawsuit to the extent that that is possible. So that's kind of, I'm not so worried about kind of the scope of the types of outright missing certain types of violations. I am kind of worried about maybe I'm not capturing penalties assessed by other sources than what's in my data.
Sure, and I think it's definitely a case that many of these issues will not be seen publicly due to predispute arbitration.
Yeah. And yeah, if I had arbitration data, it'd be amazing, but I don't think that's something that arbitrators are willing to share.
Yeah, it's kind of the confidentiality is both a feature and a bug, depending on how one views that process.
Yeah.
Even in cases where non-financial misconduct is concurrent with financial misconduct, you found that relationship to be insignificant with what you call high violation industries, hospitality, for example. Could you explain that effect a bit and what it means for maybe the signaling value?
Sure. So just to kind of rephrase what you just said, I look at high violation industries and I look at the relation between the two types of misconduct in, like you said, hospitality, retail, things like that. And then kind of I just look at other things. And I do find that my results are entirely concentrated in industries in which you wouldn't expect to have a lot of wage violations. To me, in a way that makes sense, because what I'm really trying to pick up here is, a deliberate actions on the part of the firm, right? To say, okay, we need to, to come back to the IBM example, to say, we really need to make earnings. Let's cook the books and screw over our employees and do it all at the same time, a little bit of each. The thing with the hospitality industry is that a lot of these violations might represent just, for example, the manager at the local McDonald's is a bit of a jerk, right? That doesn't necessarily say that much about corporate culture, but because there's so many, there's so many branches, it's so labor intensive, there's so many kind of wage rather than salaried employees. In a sense, it's a bit, it's obviously you'd prefer that these companies had fewer of these wage violations, but in a sense, you can't really disentangle, intent from top management from just, random stuff that happens kind of on the ground level. You might see a bunch of wage violations, but unless it's something really systemic, you don't necessarily know that it represents kind of a strategic action at the firm level versus just something that's happening maybe in a few branches. But if you contrast that with a company like IBM, right? IBM's employees tend to be, well-educated, skilled laborers, and there shouldn't be too much of a reason to underpay them. Most of them are salaried. The ones that are wage workers are getting much higher wages than someone working at, an entry-level job. And so these are companies that their volume isn't as high, but they make money on margin, right? They make money on intellectual property. And so these are the companies that shouldn't have to be underpaying their employees because, it's really what their employee, they're really making money off their employees' skills. And so when you see that these companies, the ones that are kind of where, maybe a little bit of underpayment here or there is not just something that might accidentally happen in the course of doing business, it's a much stronger signal that something else is wrong in the firm. So essentially, when you observe non-financial misconduct, when you observe a wage violation specifically at a company where it's most of the workers are sort of well paid, well compensated, and do skilled labor, that likely indicates that something is wrong and coming from the top. Whereas when you see a wage violation at, let's say, McDonald's, you don't. It might be coming from the top, but it might just be something where you have a couple of local managers, you have maybe 10 or 15 or 20 stores that have gone rogue, and it doesn't really reflect anything else, sort of anything more big picture about the firm.
A lot of this is really focused on what is within the realm of control from folks at the top, what is centralized, what levers might they use to manage earnings in inappropriate ways. You also tested several corporate governance variables for their ability to help detect financial misconduct. What did you find there?
Yeah, so I looked at a couple of things. I looked at internal controls and I looked at board independence. There's more that I would have liked to look at, but it's just kind of hard to figure out. And the reason this is actually more to try to get a sense of the costs of misconduct, or at least the perceived costs for those at the top. The idea here is more. It's not so much that boards directly directly say you should do this, you should do that, but it's that, for example, maybe a firm with good governance is likely to be better at monitoring its its executives and its employees. And so if I'm less likely to, for example, to suggest to, I'm less likely to give a directive that says, you should underpay your workers if I know somebody on the board is watching me. And in general, we sort of, and there's been some, there's been some sort of back and forth in the governance literature, but in general, we tend to view independent boards as having better monitoring capabilities. And so I look at what happens when board independence goes down. What happens when you replace an independent director with a director from within the firm, right? So somebody who might have a conflict of interest. And I show that when you decrease board independence, that's sort of one of the main situations in which you see the relation between non-financial and financial misconduct getting stronger. The idea being that when this kind of common cost goes down, right? So when the monitoring goes down, I feel like I'm less likely to get caught, and so my perceived costs go down. And when that cost goes down, you see that both types of misconduct go up, and that kind of shows that, at least to me, that they're positively linked. Another thing I was trying to get at here was whether, in a way, they're substitutes, right? So to look at if something, and that's when I look at internal control weaknesses as well, because internal controls, at least this, when an auditor discloses an internal control weakness, it might indicate, that the firm has bad controls in general, but the internal control weakness specifically, the auditor is only really talking about the financial reporting capabilities, not the firm as a whole. And so, I can observe situations in which the costs of financial misconduct are lower, right? Because if the financial reporting environment is poor, internal detection is less likely. But it's something that doesn't affect the cost of non-financial misconduct because those are operational decisions. And so I show there that when internal control weaknesses happen, it seems like firms substitute away towards more financial misconduct. So it's in a sense, it's trying to get at this, trying to reinforce my kind of main argument that these reflect opportunistic behaviors, not just corporate culture.
I think this paper has a lot of kind of practical potential, and I kind of wanted to maybe close with that. What use would the insights of this paper maybe have for the SEC or other securities regulators in being able to improve their detection of financial misconduct? And I might ask that same question for how would it be useful for external auditors, for example, to see if there are any red flags that they might want to take a closer look, or how might investors or markets be able to use these insights?
Sure. So one thing is, I didn't put this in the paper, but another thing I looked at was to say, okay, so I know the exact dates that these violations were announced, and do investors react to them? And except for, the very largest cases like the, Deepwater Horizon or, Volkswagen or a couple of these other really high profile cases, in most cases, there appears to be no investor reaction, which is to say investors have historically not really cared about this. But one thing is, and that's, like I alluded to earlier in the podcast, that's primarily because of materiality. And so when the fines are small, if I'm an investor, I say, why do I care? It's just a cost of doing business. But to the extent that if you're an investor, you care a lot about, the trustworthiness of the company's books. You want to know that the income is what, the earnings number is what the company says it is. You want to know that, for example, the sales growth is actually what they say it is. And so to the extent that something that a lot of, especially, for example, short sellers will do is to try to predict the likelihood that a company is lying to you, right, in its financial statements. And so to the extent that you know now that, when they're engaging in non-financial misconduct, this actually kind of says something about their financial reporting as well. You now become better at actually predicting something that is material, right? So we see that market reactions to SEC enforcement actions tend to be quite large. The enforcement actions themselves can can come with penalties in the tens of millions, and so the biggest benefit, at least to investors, I think, of this paper is to say, hey, look, this ESG, environmental, social, and governance stuff, right? There's been a bit of a sort of push towards it, towards more, I guess, what you might call socially responsible investing. And there's a bit of pushback on that. And the pushback is along the lines of, why should we care? These guys, why do you care about environmental attributes? That doesn't seem to predict financial performance. And so I can now kind of counter argue based on what I find is that, sure, it may not directly predict financial performance, but it does predict the likelihood of financial fraud. And to the extent that we care about that, we should be paying attention to this kind of smaller stuff too. And I guess why would regulators care? One thing to note is that, again, because of sort of the institutional features, because the SEC has to sort of prove that, the company intended to mislead you while these other agencies didn't. If I commit financial and non-financial misconduct right now, it's almost certainly the case that the non-financial misconduct is going to be detected first, right? And so if I'm the SEC and I could say, oh, this company seems to be having a lot of unusual non-financial misconduct violations, maybe it's worth investing some resources. So it's, in some sense, it could help. The SEC has limited resources. And, so given sort of how labor-intensive and time-intensive each investigation it conducts is, the SEC needs to be smart about the investigations it undertakes. And so this is kind of just another tool in the SEC's arsenal to say, hey, look, this is something else that's happening at the company. And maybe it means we investigate one firm instead of another, right? Obviously, they know a lot of stuff that they never make public, right? But this is something that maybe could, on the margin, tilt their decision towards investigating one firm over another.
And so it's almost as if, particularly on the socially responsible investing piece, an organization or leadership that acts with integrity in one area is more likely to act with integrity in another, and conversely, one that lacks integrity in one area might lack that integrity in another area, and we may care less about one area just from a financial perspective, but we may care a lot more about the integrity of our financial statement.
Yeah. So even if you're one big reason that people care about this kind of socially responsible investing is just, it tends to be almost a thing of a personal thing, right? To say, I don't want to invest in companies that make the world a worse place, however you define that. And so, what this kind of says is, even if you're just kind of a myopic investor, you just care about profits, you don't care about externalities, it's still worth paying attention to some of the ESG stuff, because that actually tells us more about what the firm might be doing. And it tells us more about the attributes that you as a myopic investor do care about.
And for auditors, is this something that might be useful for them in terms of scrutinizing a company a little bit more? Obviously, auditors, just as the SEC, have limited resources on any engagement and have to choose where to look and want to delve into a little bit deeper. Is this something they could use?
could be. I don't see kind of as much of a first order implication for the role of auditors, unless, of course, so if we're talking things like regulation, it could be useful, for example, for auditors to, or for there to be an audit of a company's non-financial performance. But I don't know. That's not, it's not something that an auditor has to do at the moment. But it is something, for example, if a company wanted to sort of have its non-financial behavior voluntarily audited, that could be something which may now be of value, right? To have sort of a third party come in and certify, that, this company behaves well.
Or might it be the case that if an auditor, for example, goes on violation tracker and sees that the company's had a lot of non-financial violations, for example, wage and hour violations, they might scrutinize or be concerned that there's some inappropriate management of earnings going on?
Sure, and it might also sort of make them look more carefully at when they issue an internal control, when they say that the company has an internal control weakness. And it might also sort of, in their, the auditor provides an opinion each year on the company's internal controls. Is it good? Is it sufficient? Is it not? And so maybe, for example, this could inform the opinion they provide on internal controls, and maybe they can incorporate, even though internal control weaknesses nominally only reflect financial reporting, there could be value in taking this into account when assessing that.
Our guest today has been Aneesh Raghunandan. Aneesh, thank you for joining us on the Business Scholarship Podcast.
Yep, thanks so much for having me.